My name is Jason Bowman, and I'm joined today by CPA Dan Henn. How you doing, Dan?
Doing wonderful.
Good. And welcome everybody to our third and final webinar in our February 2017 Tax Resolution Level 1 course. Today we are going to be talking about one of my favorite subjects. Actually, this is probably my absolute favorite subject in all of tax resolution, and that is installment agreements. And oh yeah, by the way, we'll be talking about CNC as well. So we've got a lot to cover today, so I want to jump straight into the material. Reminder, you must answer at least 3 polling questions per hour to get credit. CPAs, if you need to, we probably will be here for 2 full hours, or 100 minutes, I guess, hour and 40 minutes. For those of you that are CPAs, if you need to bolt at the 75-minute mark, as long as you've answered 5 polling questions, CPAs only can get the half-hour credit increments. Us EAs, we are relegated to the integer values only. I'll send out certificates of completion over the weekend, as well as links to all 3 replay videos. Those will be in the same email. Slides were emailed out this morning. They're also available in the GoToWebinar control panel under the handouts pane. Feel free to pop any questions that you have into the questions box. And if you are available tomorrow morning, I'd like to invite you to join me for a 5-week Saturday mornings, or I guess afternoons for those of you on the East Coast, marketing webinar series. So you can go to taxresolutionmarketing.com to learn more about that. So that starts tomorrow. Our course objectives for today are to understand the pros and cons of installment agreements. Yes, there are some negatives. We'll define the various types of installment agreements and their qualification criteria. We'll talk about the installment agreement process and define the requirements for pending installment agreement status. And we will spend probably a good 10-15 minutes talking about the new Streamlined test criteria that went into effect on January 1st. So I know that that's a subject of interest to a lot of folks, so we will spend a fair amount of time talking about that. So let's get our first polling question out of the way. And yes, I am recycling the polling questions, but I've changed the order and I've added some new answers on some of them. So yay! So be sure that you hit the submit button. That's created some issues for folks in the past that forget to hit that submit button after they click their answer choice. So be sure to hit the submit button and get that in. And this applies to everybody. I know enrolled agents aren't necessarily used to doing the polling questions the way that CPAs are used to, but we enforce the same rules across the board for everybody. So I'll leave this up for another 20 seconds. Dan, would you like to briefly introduce yourself for those folks that maybe might be joining us for the first time?
Well, if this is your first time here, I'm Dan Henn, CPA, down in Rockledge, Florida, in the area known as the Space Coast, just east of Orlando. And it's a beautiful, sunny, clear day. We're supposed to hit like 73 degrees today. And so the joy of having this time of the year is we also have to deal with the 95 degrees in summer, which is a very long time for us here. But I'm a tax practitioner, do what many of you guys do, but I also do tax resolution work and really enjoy it, as well as helping teach this with Jason. Just spent a month of November and December teaching a bunch of practitioners here in the state of Florida, and we'll be getting on to it again after tax season.
Sounds like fun. I'm looking. By the way, I'm looking forward to the road show. I'm making some pretty interesting plans. I'll talk to you offline about that. So thanks, Dan. Welcome. Thanks for being here. So I always want to start with this. There are some tax professionals out there that they don't really necessarily have a basis yet for understanding what exactly tax resolution is. Every year, I've been doing this I've been speaking since, 2013, I think, is when I started doing the public speaking about this stuff. And even today, it still surprises me sometimes that there are tax professionals that they automatically inherently believe that tax resolution equals offers and compromise. Okay, and the fact of the matter is that that's just not true. So this is why you should care about installment agreements. The bottom line is that installment agreements are the primary thing that you're going to set up for people. I mean, this is your bread and butter. This is what you're going to do all day. Okay, if you're a full-time tax resolution practitioner. So in fiscal year 2015, the 16 data is not out yet, but in 15, the IRS accepted 27,000 offers and compromise out of 7.5 million collections cases they closed out. Okay, do the math. That's 0.37%. All right. So you know, and the offer program, the original congressional action on offers and compromise was originally passed, the first bill, in 1965. Okay, this is not a new tool, but it has always been the least common option, and it has to do with the fact that there's eligibility criteria. Because offers and compromise are the least frequently used tax resolution strategy, we don't even talk about it in level 1 because you don't need to know about it for the bread and butter bulk of your work. Okay. About 15% of tax debtors will end up in non-collectible status. During our second half of today, Dan's going to be taking the reins and talking about CNC. So that will be your second most common vehicle that you'll use. So it is worth knowing and understanding. This is, by the way, this is completely anecdotal, these numbers from my own experience. About 5 to 10% of your cases will end up involving the liquidation of assets or doing cash out refinances, doing factoring arrangements, doing leaseback arrangements, you know, to basically turn assets into cash to pay off the IRS. Everybody else, over 3/4 of every case that you work, be it individual or business, will be resolved through an installment agreement. This is the bulk of what you're going to be paid to do. All right. So that's why installment agreements are so important to understand. There are some benefits, obviously, to an installment agreement, but there's also some downsides. So real quickly, I want to talk about these. When an installment agreement is being reviewed, so you make a request, while it's being reviewed, if you're going to appeals on a denial, and for 30 days after your request is rejected, if that's the case, you get protection from levy action. Okay? And in the vast majority of cases, the IRS cannot, by law, levy during a pending installment agreement request. While you're making payments on an installment agreement, they also cannot levy. Under certain conditions, you can get the lien removed. The taxpayer, if they're in a seasonal business, or their income is somehow seasonal, you can get a seasonally adjusting installment agreement. So, for example, if you're in an area that is heavily based on tourism, right? I'm sure you get a little bit of this down where you're at, right, Dan? Some tourist season variation.
Yes. A big touristy area.
Yeah, and so businesses that rely on that tourism revenue, maybe during certain times of the year, like I would imagine now, things probably aren't exactly all that hopping.
For us, it generally runs from about April to September, October. It's for two reasons. One, snowbirds, and two, that's kind of the period when people come from spring break through the summer for vacations.
Okay. So I actually have your area backwards. So you know, if there's fluctuations in income like that, you can have those incorporated into a variable installment agreement. So maybe for 4 months out of the year, the payment is, you know, $5,000 a month, and then the rest of the months it's $500 a month. Okay, very common scenario. And then under certain circumstances, you could potentially qualify for a partial pay installment agreement and actually never have to pay the full amount due, which if you squint real hard looks an awful lot like an offer in compromise. Okay, the partial pay installment agreement, I'll briefly mention it here during our class today, but it does have a lot of moving parts in and of itself, and so we actually have an entire 2-hour class on that alone that Dan normally teaches. So we don't have that on the schedule for the next couple of months, but we will definitely be covering that in some of our live events and probably a webinar later this summer. There are some downsides to an installment agreement. There is a lot of discussion, obviously, some of it politically motivated going on right now, about user fees, okay? IRS and other agencies are under fire for implementation of user fees that some people don't understand. They don't see how it confers special benefits, etc. But this is where things stand as of right now. Most user fees went up except for those connected to low-income taxpayers and use of the OPA, the online payment agreement tool. So if you set up a new installment agreement, and let's say through a revenue officer or on the phone through ACS, the user fee is going to be $225. If a taxpayer applies online or you do it for them, it's reduced to $149. You'll see a lot of things going on where the IRS is trying to push people to use online services for obvious reasons. And so therefore they cut the fees in order to encourage that. If your client defaults on an installment agreement and you need to get it reinstated, or if they accumulate another tax debt period that you need to tack on to the installment agreement, it's going to be $89 to reinstate or amend an installment agreement. If you do a direct deposit or direct debit installment agreement or a payroll reduction, then the user fee falls to $107 if you do it through ACS or a revenue officer, $31 if you do it online. So the cheapest user fee is to use the online tool at irs.gov, and if you have power of attorney, you can do it for your client. Okay, so you use the online payment agreement tool, and you agree to either a payroll reduction or direct debit. Okay, that's how you get the lowest fee. And then if they meet Department of Health and Human Services low income guidelines, it's $43 for setting it up offline. There are varying levels of financial disclosure, and more often than not, this is a kind of a practice tip for you. This is where you're going to butt heads with your client, okay, is on the financial disclosure requirements. And we talked last week extensively about the financial requirements, why we need them. Just remember, use the mortgage analogy, okay? The level of financial disclosure can be none, partial, or full. There are obviously mandatory monthly payments. A lot of people don't like that. It tends to tick people off that even though they're making payments, they may not actually be decreasing the debt that much because penalties and interest still continue to stack up. There's also the possibility the taxpayer may not be able to full pay the liability within a reasonable amount of time, and they may end up paying all the way through the end of the 10-year collection statute expiration period. And then also, if they have a refund coming to them in any way, shape, or form from the government, they're never going to see it. Okay, so obviously that's where tax planning comes in, and you can provide a service to your clients to make sure that they don't get a refund. Any thoughts on any of this, Dan? Either benefits or downsides?
You know, again, the biggest pieces, I mean, I usually just tell my clients that when it comes to the user fees, you know, they are what they are. They come out of the first payment or two, or depending on what their payment amount is. You know, I try to get clients into doing direct debit is better, just to, again, get a reduced user fee. The financial disclosure, if, you know, this is where, as you'll go along and as Jason explains the details of this, you'll understand what none, partial, and full means, and that we'll talk about some key things as to why you would want to. I mean, if you can avoid having to put your client through the financial ringer, that would be the way you'd want to try and get to the partial or none, depending on certain circumstances. But yeah, I mean, some of this are difficult to avoid, but even like the last one with the tax refunds, you know, this is where you help somebody fill out the W-4 to, you know, making sure that they're owing a small amount or very small refunds. Again, and it just depends on how they want to handle it. Sometimes the refunds might be okay because it helps them get it done quicker. So, you know, it just kind of depends on a few things. But, you know, these are the unfortunate downsides.
So there are 6 types of installment agreements that we are going to discuss. Like I said, the last one there, the partial pay installment agreement, is 2 hours all by itself. So we're not going to go too deep on that one since it has more moving pieces, but we will talk about it briefly. So the 6 are the guaranteed installment agreement, Streamlined, in-business trust fund, express or regular, and then regular installments and the partial pays. And the main thing I want to point out here is every single one of these can be set up as a direct debit installment agreement, and in some cases the IRS will require that you do a direct debit installment agreement. Otherwise, they won't give you the installment agreement under the proposed criteria. This is particularly applicable to the Streamlined IA, which is actually the animal that we'll spend the most time talking about. So getting a taxpayer into pending status. Edward, CSED is collection statute expiration date. That's the last date that the IRS has to collect on the debt before it becomes null and void. Okay, that's the end of the 10-year period. Pending status. One of the things on my checklist for working a case is that I talk to the revenue officer within 24 hours and that I collect all the financial information and get an installment agreement proposal in no later than 2 weeks after the client hiring me. Okay, that is always my target, is to have a pending valid installment agreement request, assuming that the taxpayer is cooperating, within 2 weeks of them hiring me. Okay, and the reason is, as already mentioned, you get the protection from levy action. Okay, unless there's a jeopardy or other situation involved, the IRS cannot levy, garnish wages, etc., when an installment agreement is in pending status. There's actually a special code that they tap into the IMF or BMF, and it locks out the automated levy system, and it throws up a flag when a revenue officer pulls it up saying this account is blocked from levy action. Okay. In order to obtain pending status, the taxpayer must meet specific criteria. First and foremost, they have to be current and compliant. Okay, that is kind of a chant that you should get into. Current and compliant. Current and compliant. Say it with me, boys and girls. Current and compliant.
Current and compliant. Current and compliant.
The taxpayer has to be current and compliant. What that means is they must be current with their federal tax deposit or estimated tax payment obligations, and they have to be compliant with filing requirements. So basically what this boils down to is that tax returns that they're missing got to be filed. On the 1040 side, they're going to usually go back about 6 years, since that's the criminal statute of limitation on failure to file. 941s, you're going to have to file them all. So catch up on return filing, and they must at some point in time stop accumulating additional tax liability. Okay, so either if they have a job, then their W-4 has to be adjusted so that it stops the accumulation. If they're self-employed, then you either need to flip them over to a payroll process so that they're having withholding, or which is what I normally do because they're terrible about making their ES payments, or get them making the ES payments. If it's a business, and we're normally talking about payroll here, again, get them on a payroll service. That's the easiest way to do it. Either get them on a payroll service, or they have to start making their federal tax deposits. If they don't do that, they're never going to get an installment agreement. It just ain't going to happen. Okay. Then in order to also have a properly pending installment agreement request, you must supply to the IRS identifying information like name, tax ID number, etc. You must spell out the tax types and periods to be covered by the installment agreement. And I just highly recommend that you cover every period, okay? One of the worst things that you can do is to forget to include a tax period that they owe for onto the payment plan, and then nobody at the IRS catches it, which happens. And then you're on this installment agreement, but there's 1 quarter or 1 year hanging out there that didn't get covered under the installment agreement, and then the taxpayer gets levied on it, and then they're coming knocking on your door wanting to know what you did wrong, okay? Because at that point, you've definitely done something wrong, and I hope you have E&O insurance. So
can I add something here, Jason?
Go for it.
Yeah, this is where when you're dealing with somebody and they come in and the better chances are something like at the end of the year, where time has passed, all returns for the current year are done, but make sure that, if you're dealing with it and you're now facing the next tax season, make sure that you're looking at that as well, and if that's going to be an issue, then that's the reason maybe to try and delay it a little if you can. Maybe have them starting to make payments just so that they're not getting too far behind, but you don't want to go through the process, do it, get paid, as Jason was just saying, and then later have another year add to it, and then guess what happens? You don't get to, if you're going to do it, you're going to do that for free, unfortunately, and not get paid for it. Now, if you do it and you did it, in June, and then they add another year to it, well, that's on them. But you have to explain to them early on that they need to stay compliant.
Absolutely. Yeah, and again, that can be difficult, especially when people have a track record.
Yes.
So that gets into some practice management stuff about client retention and monitoring services that you should be getting paid for and things like that. But that's a whole other topic. So you have to include identifying information, identify the tax liabilities to be covered, and indicate your proposed payment terms. Okay, so I mentioned earlier the seasonally adjusting installment agreement. If you want that for your client, you have to indicate it in your letter. And I will point out, I have never once in my life filed a Form 9465. Never have, never will. And why is beyond the scope of this presentation, but I always use a letter, okay, to fill in all this information. The letter allows, one of the many things it allows me to do is to cite the exact type of installment agreement I'm requesting, because the 9465 doesn't include that, okay? So if I want to say I am requesting an installment agreement under in business trust fund express IA criteria, I can say that. The 9465 doesn't have a box to check or really a space to write that in. Okay. So I like specifying which program I'm requesting so that me and the RO, ACS, whoever I'm talking to, we're all on the same page about what expectations are. So if they say, why didn't you submit a 433B, I can say, because it qualifies under In Business Trust Fund Express criteria. That's why. Okay. So that said, let's get our next polling question out of the way.
While you're doing that, just to get a couple of the questions here, you know, Amit, Jason actually answered your question there, but Edward, you're asking about the installment agreement extending the status. I'm assuming you're talking about the collection statute. Each time you get your client into a new installment agreement, and you're going to have that with some people where they're going to be in one for a couple of years, they're going to miss payments and it's going to default, or they're going to add to it, it's going to default, and each time you get it in there, it's another 30 days added to the collection statute. So that's always a good thing to make sure you let them know, because all they're doing is adding time to it.
Yeah, but the nice thing is it's only 30 days, right? It's not like an offer and compromise where you're adding,
Yes.
a year, or, appeals.
Appeals or bankruptcy.
Yeah, if you take a denial of an installment agreement request to appeals, understand that you're going to toll the CSET on that. Okay, while you're in appeals, so that's something to be aware of. So yeah, good point. Thanks, Dan. All right, let's talk real quickly about guaranteed installment agreements. If you've ever seen or heard the commercials on the TV or radio from the big national fly-by-night tax resolution companies, you'll often hear them say, if you owe the IRS $10,000 or more, okay? If you've ever wondered where that $10,000 threshold comes from, it's from this.
That's not how they say it, Jason. Tell them how they really say it.
Nah, like beyond the scope.
Oh, okay.
Not going to get into that today.
Okay.
The guaranteed installment agreement it's codified into statute, actually. Okay, this is not something the IRS made up. This is something Congress actually wrote into the code. So if the taxpayer owes income taxes in the amount of $10,000 or less, not counting penalties and interest, so $10,000 or less in principal tax, income taxes only, and they can pay it within 3 years or before the 10-year statute of limitations expires, they can get a guaranteed installment agreement. No financials are required. A lien won't be filed. You don't have to talk about assets. No supervisor has to sign off on it, and the whole thing can be done online. Now, these types of installment agreements, obviously these are the easiest ones to set up, and they're called guaranteed because if you meet the criteria, the IRS is required to give it to you. They are not allowed to refuse it, okay, under the law. And the beauty of this is you can do it all online. Before they took it away from us, you could use the electronic account resolution tool inside eServices, but that's been gone for a couple years now, unfortunately. But if you have power of attorney, okay, if you have 2848, not 8821, you got to have 2848 authority here, then you can do this for your client, okay? And again, CSED, collection, statute, expiration date. That is the end of the 10-year statute of limitations on collection of the debt. P&Is, penalties, and interest. So this one, I've charged clients for doing this. I wrote an entire chapter of my book dedicated to this, and I would give people copies of it and say, here, go do it yourself. I wrote a blog post on my website about it, and that walked people through how to do it themselves. But even with that, there's people that just don't want to deal with it, and they'll pay you to do it for them. Okay, Dan, the 3 that you did in one fell swoop, were those all guaranteed?
I can't say they were all guaranteed, but they were all, probably under $25,000 at the time.
Okay, so they were guaranteed or streamlined.
Right.
Tell that story real quick. I think for those the folks that haven't heard it, it's worth hearing.
Yeah.
Give the short version.
It was not long, about 6 months after I had met Jason and started learning this process, that I was leaving money on the table. This was extension season, so I had done like 3 1040s in the September timeframe, and I went and called the taxpayer practitioner hotline, or the practitioner priority service, and waited on hold for about 30 minutes, and then got with the agent and the 3 people that I needed to get set up into an installment agreement. In the other 30 minutes that I was there, I got them all 3 set up, later billed them all $250 each for it at the time, and which is almost as much as I was charging at the time for their 1040. And I was not billing anything extra, as I'm sure many of you guys have been doing that, and then set that installment agreement up, and got for that hour $750 for that hour, and half of it I was even working on other things. Now, people always ask me about the hour. Well, I wasn't billing by the hour, I was billing by the job. I billed them each $250. So if I could get $750 an hour, I would be doing that all day long. But that just goes to show you, and it was pretty simple. I think they were all under $25,000. I called them up and said, hey, here's what the parameters that they want to do, and as long as the math works, that it can be paid within the information that Jason is showing you for each particular program, then it's pretty much a slam dunk.
Yeah, and they'll let you do multiple cases per call. They cut you off after 3, but they will let you do that. So
yeah.
For those of you that are doing guaranteed installment agreements directly inside your tax prep software using the form 9465 and charging people $50 for it, well, you're doing it wrong. Okay, and the only thing you're doing is shooting yourself on the foot on the value of your services. Okay. Edward, OPA, Online Payment Agreement Tool. That's the IRS.gov installment agreement tool. Okay, so guaranteed installment agreements. A lot of folks don't think that you can, get paid for doing these. You're not going to make a lot of money doing this. It's not. You're going to be your bread and butter. But for those taxpayers that just simply don't want to deal with it, charge them a few $100, get this set up for them. And you're off to the races. Okay, so these are the simplest way to go, and I don't know the exact number. I'd be willing to bet a quarter or a third of tax debtors actually fall into this on the 1040 side. Okay, so this is a pretty common tool. Now we're going to get into the 2 slides, this one and this one, that probably matter the most out of this entire 2 hours. All right. According to the IRS themselves, based on an analysis of their databases, 90% of all tax debtors are Streamlined eligible. Okay. And in my 8 years of doing this, I did more of these than anything else. Okay. Streamlined installment agreements are your bread and butter. This is what's going to pay the rent, the mortgage, the food, put gas in the car. If you do if you're going to build your tax resolution business, this is the majority of what you're going to be doing is these. Okay, cannot overemphasize how many of these that you'll do. So the Streamlined installment agreement criteria, there are a couple of step-ups that have happened. So in 2011, under the Fresh Start program, the threshold was increased from $25,000 to $50,000. Okay, and you'll notice that on the guaranteed installment agreement, the dollar limit was $10,000, not counting penalties and interest. Well, the $50,000 threshold for a Streamlined installment agreement does include the penalties and interest. Okay? This applies to any individual tax. Now, for businesses, they can also have a streamlined installment agreement, but the criteria is a little bit different. The thresholds are a little different. If the business is still operating, okay, it applies to income taxes only under $25,000. If the business is out of business, then it can be any tax type, including payroll taxes, up to a $25,000 threshold, or if the business was a sole proprietorship, up to $50,000, including payroll taxes. All right. So it's important to understand these distinctions between the individual side and the business thresholds. Any questions on that? Pop them into the question pane, and I'll make sure that this is clear. But it's pretty important to understand these thresholds. Okay. Also, there is a time limit. In order to meet streamlined criteria, the taxpayer must be able to full pay the tax liability with whatever their monthly payment's going to be within 72 months, or the collection statute expiration date, whichever is sooner. Okay? So 72 months or the collection statute expiration date, the end of the 10 years, whichever is sooner. Okay? Typically, the financials are pretty limited in terms of what they ask for. If they owe less than $25,000, so if they're between $10,000 and $25,000, you're not going to be asked for any financials at all. And if you are, then you need to politely tell them, look, they owe less than $25,000. Financials aren't required, so bugger off. If the balance is over $25,000 and less than $50,000, then you're going to have to usually supply partial financials. And what I normally do on this is I will do a ballpark back of the napkin 433, okay, A or B, and send that to the revenue officer with written across the top of each page. It's going to say estimated values, okay, and I have never had that rejected by our revenue officer, all right? So if you do this over the phone with ACS or Campus Collections, then it's pretty much going to be the same thing. You walk through it, ballpark it, and you're going to be fine. For a business, submit a P&L, okay? That demonstrates the fact that their books are in order, and it automatically shows what's left over at the end of the month to make the payment, all right? Now, in green, you'll notice here, waived through September 30th. The requirement to provide partial financials for the $25,000 to $50,000 level of debt has been waived under a new test that went in effect January 1st and is running through the end of the fiscal year. Okay, so September 30th, this test is done unless the IRS decides to keep it and they insert it permanently into the IRM. All right, so around August, September, you're going to be watching the IRS guide wire and all that stuff for the updates on this as to whether they're going to take it away or make it permanent. All right, so be on the lookout for that. And I'm sure we'll be doing a webinar, in October about the changes they make to the changes, because there will probably be changes to the changes, and then there will be changes to the changes to the changes. Okay, that's what they do. So the financials are gone for the next 9 months. Okay, so take advantage of that with your clients. Lien filing is not required on balances from $10,000 to $25,000 under typical streamlined criteria. Under this test, they are extending that to the $50,000 threshold. Okay, so a taxpayer that owes up to $50,000 of 1040 debt can actually now get away with not having a lien filed. If the lien has already been filed in the past, it's not going to get withdrawn or released just because of this test. Okay, So if they've had a debt for 2 years, they've already had a tax lien from several years ago, you can't go to the IRS now and say, hey, you should take the lien off because they're doing this test criteria. That's not what they're doing. That's not what this is about, okay? It's for new tax debtors, okay, that don't have a lien filed yet. Asset disposition won't be required. Group manager approval is not required. If the balance is between $25,000 and $50,000, it's going to require a direct debit directly out of their checking account or a payroll reduction directly. So if the taxpayer is not willing to do the direct debit, they do not qualify for Streamlined criteria, okay? And this has not been waived under the test, okay? If you have power of attorney, which you're going to have if you're doing this, you can use the online payment agreement, OPA, online payment agreement tool, and get the reduced user fee and also the faster service. The other nice thing about using the OPA is that you're not going to get the questions about the financials, okay? If you're talking to ACS, they're still going to ask you the 433F questions, all right? Which is a waste of your time, and you can sit there and argue with them about saying financials aren't required, but their little book, which is the only thing that they know how to use, is going to say, ask these questions, okay? And they're going to not know what to do if you refuse to answer them. So to avoid all that hassle, plus the time waiting on hold, do it online, okay? Use the OPA. And like I said, 90% of taxpayers are OPA Streamlined eligible per IRS data. And yes, people will and do still pay our high fees for this type of representation, okay? Again, they don't want to deal with it.
Hey, Jason?
Yeah.
One of the questions real quick is, why do you think that the IRS is doing this Streamlined program?
It's because they don't have the people to sort through everything. That's why.
I mean, basically, I think it's a staffing, it's a staffing manpower issue that they're trying to deal with them quicker and easier in a different fashion. Yeah,
I mean, it comes down to staffing. And also, they're trying to clear up the backlog. Think about it. The third-party private collection agencies are going to kick off here in May, right? So the IRS is going to have to pay all of those people a commission for anything they collect. So the IRS is going to collect more money if they do it in-house. And so this test, I think, is partially driven by the private collection agency factor, because the IRS just wants to bring in money, and so they're like, well, these people are kind of out of the system right now. We might as well try to do something to bring them into compliance and collect a few bucks. You know, it's not like they're losing anything by increasing the threshold, okay? So, you know, I think that's part of it.
Okay.
Okay, so again, this is temporary through September 30th, okay? And we won't know whether these things are going to be made permanent, what they're going to do. We're not going to know that until the end of the fiscal year, all right? So to back up, the test includes the waiver of the financials, the collection information statement, the waiver of the lien filing, okay? And then it also introduces a new category of criteria for balances up to $100,000, okay, for 1040 liabilities or out of business sole proprietorship debts, okay? The in-business income tax threshold is still $25,000. The defunct corporation or partnership threshold is also still $25,000, okay? The $100,000 threshold only applies to 1040 debts or sole proprietorship debts that are out of business. Okay, does not apply to other entity types. The time limit is extended to 84 months, which is dang near most of the 10 years. So, and it's the lesser of the 84 months or the collection statute expiration date. Now, here's an interesting one. The financials are not required. Think about this. A 1040 debtor that owes $90,000 can now get away with setting up a payment plan without any financial disclosure. That's huge, all right? But in order to do this, they have to be on a direct debit installment agreement, okay? If the taxpayer refuses to do the direct debit or the payroll deduction, they are not eligible for Streamline, period, okay? And they're going to have to go through the regular installment agreement route, right? For those of you that are asking fee questions, because of Federal Trade Commission rules and antitrust laws, we can't get into fee discussions during these presentations, okay? That was something I learned last year after I got slapped a little bit. The asset disposition is not required, lien filing not required, group manager approval not required. Now, this is not available through a revenue officer. Okay, it is also not available online. Okay, you can only do this expanded $100,000 thing through Campus Collections or ACS. Those are the only two places you can do it. So you have to do it over the phone. And if your taxpayer is already in field collections, meaning they have a revenue officer assigned, the revenue officer can't do this. All right? You're going to have to go through regular installment agreement criteria. What I suggest that you do in order to reduce your hold time, especially this time of year, is call the Practitioner Priority Service, the Tax Practitioner Priority Hotline. Then request what is called a Priority Service Transfer to Campus Collection ACS. Okay? Campus Collection ACS is exactly that. It operates at the IRS campuses, okay, rather than central ACS. Campus Collection ACS is going to theoretically be easier to work with and not as heavily bogged down. This time of year when they shift people around for return processing and stuff, that might not be the same, but outside of return season, okay, that's going to be easier. GM is Group Manager. We're not going to get into the hierarchy of field collections, but group managers are revenue officers' bosses. So, again, you have to be on the phone for this, which kind of sucks, but it is what it is. Okay. George says, I got a 10-year, 120-month installment agreement on a 2014 payroll tax case. Group manager approval was needed. George, yes, because that was trust fund was involved. Yeah, if there's trust fund involved, that does require group manager approval, and we'll talk about this. We'll talk about that here in a minute. Okay. So again, these two slides right here, honestly, are the two most important in this entire slide deck, because this is going to be the bulk of the work that you do. Dan, anything that you think I missed here that we should cover? Any other thoughts?
No, I think you got it pretty much covered. Again, you know, the biggest thing here, guys, is that when your client qualifies for any of these levels, and there was a question about, you know, what if they add another year to it? Well, this is where you need to play with the numbers. If they get over the magical, you know, $50,000 or $100,000 and they're very close and they can make a lump sum payment to get under, right, and you now qualify, that's the thing you got to be looking for, is what can you work, what can you do to do the least amount of work, both for you and your client, and get them on the road to recovery, basically.
Yeah, if your client owes $104,000 in 1040 debt and they have not been assigned to a revenue officer yet, then have them make a $4,001 payment in order to knock the liability down to $99,999, and then call ACS, okay, and get them on a payment plan. That, I mean, that's what to do. Edward, can you elect which year to pay first? You should always start with the most recent tax period and work backwards, because the most recent period's usually haven't maxed out their penalties yet. If you make a voluntary payment, you can designate it to whichever period you want. Always apply it to the most recent period and quarter, or year or quarter. If you are making installment agreement payments, you cannot designate those payments. The IRS will apply them to the oldest periods first, and you can't do anything about that, okay? So it is time for our next polling question.
Yeah,
Dan?
we have another question that is up there that says, can you cancel a 9465 and do an online agreement, or can you combine somehow? You know, honestly, I don't know. I think once you've submitted it, you know, I don't know that there's any...
If you have a 9465 in, you can make the phone call to ACS and get it set up over the phone.
Right.
So if they haven't taken
Assuming
action on the 9465.
Right, if they haven't done anything yet.
But if they have, you're already in the process anyway. There's no point in interrupting it.
Right. And another common question comes that, what if you're in an installment agreement and now your client can't make that payment anymore? Unfortunately, it's just like the mortgage company. They're not going to talk to you unless you miss payments. And effectively, you've got to default and restart the process over to get into a lower payment. Assuming that, again, now they meet the criteria, you got to have that discussion before they do that.
Yeah.
You know, and let them know what hoops they have to jump through now, looking at the statute, and are they going to have enough time left? You know, does that change it to a partial pay, and then you're going through the ringer a little bit there. So, oh, and then just to follow up too on Edward's question, as Jason said, you can elect to designate the payment if you are making a voluntary payment. Once you are in an installment agreement and making payments, then the IRS gets to designate which is always going to go to the oldest year first.
And I just want to say, I'm glad I'm not the only person that's bad at math. All right. Okay. George, we're going to get into your question kind of here after this. All right. So to go back, Streamline, notice that Streamline installment agreement that does not require group manager approval, like this goes back to what George was asked about, if they're in business, it applies to income tax only under $25,000. And George was asking, he says, well, I required group manager approval, but I got a 10-year installment agreement. Well, yeah, because George, you're talking about a payroll tax issue, okay? And I'm assuming the business is still operating. And the threshold there is $25,000, and it's income tax only. You're talking about payroll tax, okay? So let's talk about payroll tax. An in-business trust fund express installment agreement is going to be your 941 tax debt workhorse, okay? This is the equivalent of a Streamline installment agreement on the 941 side for an operating business, okay? About 60% of the tax liabilities owed. George says they defaulted on the IA and then shut down. Well, okay. We'll talk about that. About 60% of all the tax debt that's owed is 941 liability, okay? It's the bulk of what is owed to the IRS. And the bulk of those are IBTF eligible, okay? In business, so the business is operating, trust fund, that includes excise taxes, by the way. Express. Express means the same thing almost as Streamline, except they couldn't use that term because they used it somewhere else already, all right? So they used the term express. So the IBTFE is your 941 resolution workhorse. There is a $25,000 cap, and again, pay it down to $25,000 if you have to and if you can in order to get it into this, because it's such a better world than doing one of these. All right, so you want to do one of these. It is limited to trust fund taxes. The most common trust fund taxes that you will find are payroll taxes and certain excise taxes. The number of excise taxes that the federal government charges is in the hundreds. Most of us never deal with those. I happened to build a specialization for several years and built my practice while I was traveling overseas by specializing in heavy vehicle highway use excise tax, the 2290 trucker tax. That's an excise tax. It's a trust fund tax. Okay. So again, I did a lot of these. There is a 24-month time limit. Okay. And if they're close to the $25,000, obviously you're looking, you can do the math off the top of your head. You're looking at an IA payment of roughly just over $1,000 a month if they're going to do this and they're close to the threshold. Okay. Here's the beauty of it. Financial disclosure is not required. Okay. So if your tax, yay! I've had situations where I've had taxpayers that owed $35,000, $40,000 in 941 debt, okay, and they were able to beg, borrow, or steal $10,000 or $15,000 in order to pay it down below the $25,000. If your client can do that, don't steal it, but if they can do it through some other legal means, borrow the money, get it from somewhere, do a cash out refi on the house, do a lease back arrangement on equipment. If they could somehow get the money to pay it below $25,000, oh my goodness, do it, because then you'll be in this express criteria and you'll save all the headache on the financial side. All right. A tax lien is still going to be filed against the business. The IRS is not going to require that you sell assets or refinance assets, although I recommend looking at it as an option for paying down the liability, like I already said. And, George, this goes directly back to your question, because it is trust fund involved, a group manager is required to look at it and approve it, even if it's less than 25 grand. Okay. A direct debit situation is going to be required if it is more than $10,000. And again, you can use the online payment agreement tool to set up these small business installment agreements. So use it. Okay. Now, this is the in-business trust fund regular installment agreement, not the non-express version. Okay. And we'll kind of compare and contrast the two. The express version has a dollar limit. The regular version does not. The express version has a 2-year time limit. The regular version does not. The express version doesn't require financial disclosure. The regular version requires what I jokingly refer to as the full rubber glove treatment. Okay. Full financial disclosure, full 433B, everything will be analyzed, everything will be questioned, and the IRS will assume that you are hiding cash or assets. It is the same level of financial investigation as what is involved in a partial pay installment agreement or an offer in compromise. It's the exact same financial investigation. Okay? It is far-reaching and very uncomfortable for the taxpayer. Lien filing will be required. Supervisory approval, group manager approval still required. Here's the rub. The IRS is going to require that you make the effort to either sell assets or borrow against assets. Here's a practice tip for you. This is a writer-downer. And this is in my checklists. You know, it's just one of the things I do if I'm dealing with a case more than $25,000 that's 941, is bam, go to 3 different banks and have the business apply for a loan. Get those loan denial letters, because guess what? They're not going to get the loan with the federal tax lien against the business. Ta-da. And this way you have them ready to show the IRS, look, we tried to borrow. We had 3 different banks tell us to get bent. Okay? And then The revenue officer can check their little box that they're required to on their checklist saying they did their job, and everybody gets to move on, okay? Now, here, this is another reason, by the way, why I like to do a letter instead of the 9465. You can do an IBTF on a 9465. You can do it. But if I write a letter, I can say, this installment agreement request is being submitted under in-business trust fund installment agreement criteria. As such, it is my understanding that 4180 interviews will not be required and that the trust fund recovery penalty assessment will not be pursued. Okay? I put that in my letter. It's usually like the second to last sentence. And when the IRS sees that, it tells the person reading it that I know what I'm doing. I know how to protect my taxpayers' rights. I'm not an idiot, and I expect them to play by their own rules. Okay, that's kind of what I'm communicating there. So I encourage that kind of language. Make sure that the revenue officer understands that you understand the taxpayer's rights, and that if they meet in-business trust fund criteria, then you're good to go. Now, George, again, his question was, I got a 10-year, 120-month payment plan on a 2014 payroll tax case. It was operating at the time. And if you were more than $25,000, guess what you did? Even if you didn't know you did it, George, what you did was you did an in-business trust fund installment agreement. That's why the group manager approval was required, okay? And Ishmael, yeah, I know a comparison table would probably be helpful. So the IBTF E is going to be your workhorse. The IBTF regular is your backup. All right. The beauty of doing the IBTF is that you avoid the entire 4180 interview process. You avoid the trust fund recovery penalty assessment investigation. That's what the 4180 is. Sorry. So you avoid that whole process. Okay. And the purpose of an in-business trust fund installment agreement, the reason these criteria are what they are, is so that you can demonstrate that the business is financially viable and can pay the tax debt, and therefore reassure the IRS that they don't have to go in after anybody personally. That's the whole point of this. Real quick, just to cover these, before we get into CNC, regular installment agreements. And this is the actual term for them, because the IRS has all these terms for these special types of installment agreements. They actually do call a regular installment agreement a regular installment agreement. That's the actual verbiage for it, okay? So as you can tell, this is your kind of your, one of your last resort options. If you can get it into one of the specialized criteria, definitely do so. But if you can't, for some reason, then this is the way you have to go. It applies to anything and anybody. There's no time limit other than the collection statute expiration date. A lien is going to be filed. It's full rubber glove financials. Asset disposal is going to be required. Managerial sign-off is required, and you're not going to get out from under the trust fund recovery penalty interview process most of the time. All right, so it's unfortunately there are plenty of situations where you can't get an IBTF IA and you end up in a regular installment agreement for a business, and you have to go the 4180 route. Unfortunately, that does happen, and 4180 is 2 or 3 hours all by itself. And lien filing, that's an hour by itself as well. So we're not talking about lien filings necessarily here today, okay? I'm not repeating that one, George. Nice. Free medical exam. I'll just leave it. I'll say it that way. So yeah, regular installment agreement is the second to worst route to go. Partial pay installment agreement has the most restrictions. It also can, under very, very limited and rare circumstances, actually extend the CSED past 10 years. And again, it's, if you do a regular installment agreement or any of the other specialized installment agreements, once you set up the payment plan, as long as you're making payments, the IRS is never going to bother you again. Okay. Under a partial pay installment agreement, they're theoretically required to do a review of your financial situation every 2 years. TIGTA says that in the majority of cases it doesn't actually happen, but they're supposed to. A partial pay installment agreement, and again, we're not really going to cover this because it's its own 2-hour class. But if you're looking at a partial pay situation where the taxpayer cannot pay the full liability within the 10 years, you should also run the RCP calculations to determine if they're eligible for an offer in compromise. And again, we're not going to go in depth on the PPIA. Is there anything you want to say on this, Dan, since I'm kind of glossing over it?
Yeah, again, it's a whole hour, we do at least a good hour and a half on this, but the things to consider here, as Jason said, consider offer and compromise, or CNC, as we're going to talk about for the alternatives. And the big thing here is that this is one of those where there's full investigations, and I have talked to people who've gotten people into the PPIA, and they say that they do these investigations pretty regularly, unlike the currently non-collectible we'll talk about here in a few minutes.
Yeah, you're much more likely to get the investigation. But again, TIGTA, we talked about this on the podcast last year. TIGTA said that in 2/3 of cases or something, they fail to do the 2-year investigation. And Edward, yeah, right. Yeah, up to 16 years. Yeah. Simon,
it can be depending on the circumstances, yeah.
Yeah, and again, it's very rare. The 16 years hardly ever happens. Okay. Simon had a question for business income taxes. Will they only lien or request asset sale of the business only, or go after the individual? Yeah, if you're doing an in-business trust fund installment agreement, Simon, the assets in question here are only the business assets. Okay. Keep in mind that the trust fund recovery penalty against the individual is a completely separate assessment against the individual, and after it's assessed against the individual, you treat it exactly, identical, 100% the same as a 1040 debt after it's been assessed.
Right. Now, differentiate that, because he says income taxes versus payroll taxes, so the income taxes are the business's problem, not the individual's problem, though.
Yeah, so if we're talking a partnership or a corporation, LLC, whatever, the business income tax belongs to the business, even if it's a pass-through entity. Okay, so keep in mind the separation. That's why we set up entities, right? Just to create the separation, and so that's one of the benefits you get from that. Real quick, negotiating installment agreements, remember, file tax returns, stop accumulating new debt. Adjust the W-4s, get them on the payroll. And I know some people have had some heated conversations with other tax professionals about this tactic, but yes, sole proprietorships can be on payroll, okay? There is nothing illegal or anything about putting a sole proprietor onto a 941 system, okay? I would recommend, if you have a sole proprietor that has a tax liability, it's probably time to get them set up into a more tax efficient business structure per se. But even if you don't do that, a sole prop can still be on payroll. Okay. Request your installment agreement multiple ways. Okay. There is no requirement that an installment agreement has to be in writing. You can leave it on voicemail. If you send an email, to a revenue officer with all the same information. They're not allowed to reply to us by email, but we can contact them. And that's a valid installment agreement request for pending status. I always send these in triplicate, okay? I will leave a voicemail. I will send a fax, and I will send certified mail or return receipt, okay? Make double dang sure they got it, and I can prove that they got it, okay? I don't use the 9465. You can if you want, especially because it's convenient, because it's in your software. I prefer a letter. And I've got a template letter for doing that. They're pretty easy to bang out. Be sure that you specify the type of IA that you're requesting so that they know that you know what your taxpayers' rights are, okay, under the IA type. Be sure to include all tax types and periods. Don't miss any tax periods. Don't miss a quarter. That will come back to bite you. Trust me, I know. I learned that the hard way, and that's why it's on my checklist. Anytime you learn a lesson, add it to your checklist. Be ready for the necessary level of financials, okay? For an in-business trust fund IA, regular IA, and a PPIA, be ready to tap into any equity and assets. And then, you know, the trust fund recovery penalty, if you're facing that, we could talk for hours about this. I cover it more in the trust fund recovery class. But the IRS there's a 3-year statute of limitations on them being able to go after somebody for the trust fund recovery penalty. As a matter of fact, Dan had a meeting this morning, I think it was, regarding this exact situation. It was for 2007, right? And the RO is trying to come after you today.
Well, yeah, I'm still doing the due diligence, but yeah, it's a 2007. Returns have been filed. There's about $120,000 of outstanding payroll taxes, and they're coming after the company is really with him as the officer, and she wants all this records. So I'm hoping to kind of be able to put that puppy to rest because there's nothing to get, and there's no way that she can assess the trust fund recovery penalty. The only question that I have is, what does the IRS have on record? Because if they don't have the returns, then that becomes a he said, she said, since he didn't send them certified mail.
Right. So as long as the returns were filed, okay, if it's SFRs, you know, substitute for returns, no bueno. But if the returns were actually filed, IRS has 3 years to go after somebody, and so Dan's client theoretically is completely off the hook on the personal side because they're well beyond the 3-year statute, okay? But you can use that 3-year thing as a negotiation tool, all right? And again, beyond the scope of this really. Big thing, make sure your client understands never to sign anything without talking to you first, okay? Understand that minimizing an installment agreement payment has to do with the delta between expenses and income. So refer to last week's class about that. If you're going to need them, get those 3 bank loan denials in advance. Again, don't miss any tax periods. Put everything into your request. Never be afraid to ask for anything. You'd be amazed what you can get away with, especially with a revenue officer, if you simply ask. And then, again, if you have a 2848 on file, you can use the online payment agreement tool on your taxpayer's behalf, okay? So I'm going to pop a polling question up here for those that need it. Let's see, George says, my client was a single member LLC, had $100,000 payroll tax, $50,000 trust fund. $100,000 was put into CNC when the LLC was liquidated, and then told her to file an OIC for the $50,000 in trust fund. Yeah. Yeah, if your taxpayer is financially insolvent, basically, then yeah, do an OIC. There's something I call, we covered this in the offer and compromise class, I call it the OIC double whammy. But one of the things that you can do is if the business is still operating and has no intention of shutting down, but the business barely makes any money, then a lot of people don't realize this. Operating businesses can file offers in compromise. Okay, so you can get an offer in compromise on the business. They're going to force you to accept the trust fund recovery penalty on the personal side for doing so, but then you can offer out as well on the personal side. So there's the OIC double whammy. I've done, 3 or 4 of those in my career, and those are the most rewarding, believe me. ASED, assessment statute expiration date.
Right, that's 3 years from when you file the return.
Yeah.
Versus the CSED, which is the 10-year period from when the liability was established.
George said, wife is broke. All income comes from the husband who had zero involvement with, yeah, there you go. The trust fund recovery penalty is not a joint liability for a married couple. The trust, unlike a 1040 liability on a joint return, in this case, the wife got whacked with the trust fund. It's all on her. Husband doesn't owe a dime. Okay. How many QP 3 or 4? I'm not sure what your question is there, Edward. QP 3 or 4. I'm not sure what you mean by that. All right. Dan, the show is all yours. Now that I've eaten into 15 minutes of your time.
Yes. So.
You're welcome.
Thank you very much. And Edward asks, EAs can leave, I guess, if you've done your 1 hour and you want to leave. Remember, this is also very important stuff, but for those of you that can stick around, please do so. This is, just as important as everything else that we've talked about, because this can be one of those situations where, again, 75% of the time you're going to be dealing with the installment agreement status that Jason just talked about. Currently non-collectible is going to be those people who really don't have much in the way of anything. They can't really be able to do an offer in compromise because they have to come to the table with some amount, and that amount is usually more than they can afford to pay. So currently non-collectible is the next best thing, and you will find that you'll be putting people more into currently non-collectible status than you will be filing for offer and compromise. So, so go ahead and go to the next slide there, Jason. So we're going to talk about here the eligibility criteria for currently non-collectible status. CNC is how we refer to it. Understand the conditions which the IRS will close a case as currently non-collectible. There are downsides, just like there's the upsides of being in the status, and then we're going to talk about the definition for hardship for the IRS collection standards, which was what we were talking about last week in setting up the Form 433. So go ahead and next slide. So here, the Internal Revenue Policy Statement, this was created in November of 1980. It says, if after taking all steps in the collection process, it is determined that an account receivable is currently non-collectible, it should be so reported in order to remove it from active inventory, which basically means that it's put in a status, it's given a code that the IRS does not come after your client. And so we'll talk about this and what that really means, because in a few slides we'll talk about the benefits of being in an installment agreement. So now we talk about a hardship. Okay, the general rule, accounts will be reported as currently non-collectible when the taxpayer has no assets or income that are available to levy. Now that means that they can't, they're not going to go after your assets, make you sell your house or do anything like that, because under the second paragraph there, it says it would create a hardship. Okay, that means effectively that they can't meet their necessary living expenses. They're not going to be able to pay the rent, pay the electric bill, put food on the table. That's an actual hardship, as opposed to an inconvenience to the taxpayer where, maybe they can't pay their cell bill, or, they can't get their nails done. that's an inconvenience to the taxpayer, and unfortunately that's the kind of stuff that people, that's where that makes these hard conversations. But I need this. Well, need and being necessary to create a hardship are two totally different things. So this is where you have those difficult conversations, and if they were to whack the person's bank account or paycheck and it causes them the hardship to be able to do that, that's where you make a good case to be putting them into currently non-collectible. So next slide.
I just want to say,
so what it means is,
hey, Dan, just real quick, if you missed last week's presentation on the financial standards, definitely go back and watch it. I'll send out the links tomorrow. Be sure to watch that, because basically the collection financial standards are all about the IRS's definition of these basic necessary living expenses. Okay, so be sure to watch that.
Okay, yes. So ultimately here, if a taxpayer owes nearly nothing and owns nearly nothing and has no remaining income beyond what is required to live, they may be eligible, which means that what we're just kind of talking about is you've got somebody who's just really down on their luck. So benefits, statute of limitations, the CSED, still runs. So what happens is, here's an example of one I did. I had a client, when he came to me, he'd already been assessed the trust fund recovery penalty. And what we ended up doing was being able to get him personally put into the currently non-collectible status. We filed his returns joint every year with injured spouse so that his wife would still get her refund because she had nothing to do with his trust fund recovery penalty. And we put him in the currently non-collectible status with, I think it was probably 6 or 7 years left. Well, that was 3 or 4 years ago, and to my knowledge, he had since left me. That was a whole separate issue because my staff person later became his neighbor, and he didn't want her knowing his stuff. So, which she already knew anyway, but that's a different subject. But so, he's since left me, but to my knowledge, he still is in that status. And we'll talk about here in a second the downsides of that. But basically, because of budget constraints, and just as Jason pointed out, that when TIGTA does their analysis on people of being in currently non-collectible status, being in partial pay installment agreements, they're supposed to be followed up. And unfortunately, because of staffing issues, and obviously now they're under a hiring freeze, so there's a whole government-wide, federal government-wide hiring freeze. So that's going to put the crimp on other things. Hopefully, it's not going to hurt the overall service, but that's something else to see. And again, the third bullet point there is simpler for the long term than them paying an installment agreement or offering compromise, especially if they can't make the payment. Now, at the end of the day, when we did the 433 financial collection standards analysis last week, the person who qualifies here is when you determine what their income is on a monthly basis and you determine what their expenses are that's allowable, and the answer is 0 or negative, this is where they fit in the currently non-collectible status. The problem is they may have, like a guy I have currently right now, he's a realtor, not doing very well, and primarily because of health problems, that they have a large equity in their house, but they have crap for credit. And so we went and applied for him to be able to tap that equity, and he can't do it. And because of that, he has no other assets per se to really his name that make of any substance. So he is one of those that putting him into the currently non-collectible status would be a good thing for this period. And then, for true hardship, case closure is fairly simple and quick. It's just a matter of providing the documentation. Unfortunately, you do have to go and submit a 433A in this process, but where you're using the process, like, again, I use the software Canopy Tax, they allow me to input the information and easily switch between a 433A and a 433 OIC so that I can quickly do the analysis without having to run through the forms. But, this is where you go through the process and say, hey, here's what it takes to do an offer and compromise. But that's where you go through this analysis. Now, next slide. Downsides is that you must provide the full financial documentation, as I just said. You've got to submit the 433A. And in this case, to get into the CNC status, unlike Jason gave you the different programs earlier, the full financial documentation are going to be required. You have to fill out a 433 regardless of how much is owed. If they can't pay it and they don't have the ability, you have to provide that information. You're not getting into an installment agreement where there normally might be no financials required. Here you have to submit it with the documentation. Now, the second bullet point says there the status will generally last for 1 year at a time, which means that they're supposed to be coming and reviewing it every year. And I can tell you again, as a matter of practice, just again, staffing-wise, that is not happening. So this is one where I said earlier in the PPIA status, they are being more regular about those people as opposed to people in the currently non-collectible status, where the guy I just told you about previously that had the trust fund recovery penalty, in the 3 years he was with me after I had got into the currently not collectible status, they never once came knocking and asked us to do this. And again, it's easy for people to have their status change. I had a guy recently that came to me. He owes almost $200,000 back to 2002 through 2004, and a couple of small amounts from the more current years, but he was hardly making any money. Well, he just happened to be, get into a point where now he could actually be earning a couple of $1 million within the next 24 months. And that completely changes his status. He's in currently non-collectible status right now, and once we start filing returns with that income, eventually that is something that could raise him to the top of the pile. So we're trying to, beat them to the pass and hopefully get that paid off. And remember, currently non-collectible, the benefit is that the statute still runs. The problem is so does penalties and interest. So just be aware and let your clients know that. And then tax liens will not be removed if you're in the currently non-collectible status. And there was a question earlier about, does it attach to the house and the car? It attaches to everything. And technically, I don't think we've really gotten into it, that once the liability is established, technically there is a statutory lien even though the paper lien has not been filed. So, that lien exists, but even though once the paper lien is filed, yes, it attaches to everything everywhere. So it generally gets filed in the county of the state of residence, but it'll apply if they have a second home in Colorado. So just be aware of that. Now, Jason, do you have any comments on the upsides or downsides to the currently non-collectible that you'd like to add?
Yeah, just, this is from a practice management or casework or customer control kind of thing. Your client's going to say, well, I don't have any money. Why do I need to go through all this rigmarole of doing the full financial disclosure? Why is the IRS going to be, all up in my business about my about my brokenness, and it's you're going to have that question all the time. So I recommend that you just have an answer ready for it. And obviously the answer is simply, you owe the IRS money, but you can't pay it. They want us to prove that you can't pay it. Okay, very simple question, very simple answer, but it's going to come up.
Right. Yeah. Well, that goes back to, there's enough bad apples that screwed it up for everybody else, and so that puts us in the situation that we're currently in.
Yeah.
Now, Eileen asks here, do we need to go through the installment agreement process before the IRS will consider a CNC? And no, they're not connected. And then meaning that you can do the IA if they can qualify, but if they also qualify for the CNC, then you do one or the other. You don't do both.
Well, they're not going to qualify for both. You know what I mean? Like,
well,
if they can make if they can make an installment agreement payment, if that's what the math shows, then they're not CNC eligible. I mean, that's
correct. Yes. Yes. And then the question says, how long does the tax lien remain after the CNC has been approved and processed? And it's basically until the end of the collection statute, the CSED.
Yeah.
So it's supposed to, the lien is supposed to be removed within 30 days after the end of the statute, but that's something you need to stay on top of because That doesn't necessarily always happen. I did have that happen with my cousin, and when we looked at it, he did actually get the release from that, and it was within 30 days after the end of the statute that I was dealing with. So
I think what Eileen is actually
okay.
asking there is after you get CNC approved and the client is in CNC, what happens to the tax lien? The answer is nothing. It does not go away. I think that's what she's actually getting at there. So if you get a client into non-collectible status, the tax lien will not be removed. It's just not going to happen because the government wants to protect their interest if they're not going to get any money, right? They want to protect their interest in any money that you might stumble into in the future. Like Dan was just talking about his client that's going to come into maybe a couple $1 million, right? I mean, the tax lien protects the government's interest in that future cash. So they're not letting that go.
And that's why they're supposed. Yeah, and that's why they're supposed to be doing the annual reviews, and that's a drawback of being in the currently non-collectible, as opposed to say a comparison to the offer and compromise. Once you've submitted it, based on the information at that time, if it gets approved and they later win the lottery, a week later, then it doesn't matter. Where you're in the currently non-collectible status, you win the lottery, well, now they're going to want to change your status and get their money.
Right.
So go ahead and go to the next slide then, Jason. So when you're actively seeking the currently non-collectible status, obviously they just have to show the inability to meet the necessary living expenses. Again, as Jason's pointed, in every case, no matter whether it's installment agreement, CNC, or OIC, they have to be current and compliant. All of the appropriate tax returns have to be filed, whether it's payroll tax returns, income tax returns, S-corp returns, whatever it is. They all have to be filed, and then the liabilities need to be established. And which goes also to say that if somebody's having a trust fund recovery penalty, make sure that that is also assessed if it's going to be assessed before you go through this process, because you need to have all debts included here as well. Now, we mentioned that last week we talked about the 433A, and the 433A is generally if you're dealing with a revenue officer, and the 433F is when you're dealing with automated collections. So you need to go through those forms, you deal with these, the respective group, whoever you're dealing with, and you give any supporting documentation. When you're dealing with an installment agreement, like you're getting in the Streamlined, sometimes they'll ask you where the partial. I had one guy where they asked for a copy of a statement of his health insurance. So we provided that, but we didn't have to provide a full 433, and that's where you get into the partial. In this case, you're actually submitting the 433 with the documentation because we do not have the option of not doing it. This is where you also need to be familiar with your national and local standards, calculate the 433A, but when you're going through here, you're also looking at assets as well as income. So this is where we look at the 433A OIC, and you do that for comparisons to make sure, do they qualify for an offer and compromise, because the offer might be a quicker way out, especially if, here when you're dealing with currently non-collectible, you have to understand what's the risk or pain tolerance that your client has, that if they're in the currently non-collectible status, that their financial condition's not going to change. If they fear the IRS always looking over their shoulder, or they're losing sleep at night, then you may want to look at another option if that's possible. Because if they have 7-8 years left on the statute, that's a long time for somebody to sit there wondering if the IRS is ever going to come back. Especially if, hopefully they're not, but if somebody's like pretending like they're hiding something, or they've done something that they shouldn't have, and hopefully it's not something they didn't tell you about. Because if you know about it, then you have to make sure that it's on there and included. And then finally, the 656B, the offer and compromise booklet, helps you with the asset calculations. So use those worksheets as well to help you determine, because ultimately at the end of the day, they're also looking for the equity. You still need to see if you can tap the equity in assets, especially real estate, to see if you make sure that you currently qualify for that, because they can ask to see if you would liquidate certain assets to help reduce the liability. Okay. Any other comments you want to add on this, Jason?
No, just you know, one of my things I know I always do is we talked about this in the casework mechanics class, week 1. Always run RCP calculations, reasonable collection potential. That it's the calculation for the offer amount, but always run the RCP calculations, especially for your taxpayers that are broke, right? Because if they can, you know, if they're broke, they're going to be looking at either CNC or OIC, and if they can come up with a few bucks to make an offer, the offer and compromise might be a better way out because it gives finality to the entire process. Okay.
Right.
So just every case that you do, I just say always run the back of the envelope, quick and dirty RCP calculations, because that's really going to help you determine what to do for your client.
Okay. So yeah, and Eileen brings up a question here that she says, you know, that basically, will enforcement continue while the CNC application is being processed? And typically no, depending, you know, as long as you're communicating with them and letting them know that the process is, you know, what you're doing. You ask for a hold on the account, typically ask for, you know, somewhere around 120 days. More than likely they're going to give you 60, but if you ask for 60, they may only give you 30. So that's why we usually say to go, you know, be reasonable. To ask them for 180 days or 9 months or something, they're going to laugh at you and probably give you 2 weeks. So, you know, be reasonable in what you ask for. And I believe there is a short period, maybe another 30 days in the CSED, the clock being stopped. Jason, is that, do you know if there's a, just like the installment agreement process?
Yeah, but I think what she's actually asking is if the CSED stops or while they're in CNC, and that answer is no.
Right.
So if it is possible for the 10 years to expire while a person is in non-collectible status. Happens all the time. At any given time, there's about 2 million Americans in CNC, according to the IRS. And if the clock runs out, they don't owe the money anymore. It disappears. And so writing out the clock in CNC is itself a resolution option to not full pay the liability, but to satisfy the debt. If that makes sense.
Right.
So the clock does not.
So other than a
the clock does not stop. That's the bottom line.
Right. Other than a short period of probably 30 days, like the installment agreement, that would be the only time that the clock is stopped at, you know, as you're doing a filing for the process. But other than that,
or if you go to appeals,
the clock continues. Right.
Yeah.
If you go to appeals,
if you go to appeals for any reason,
bankruptcy.
Yeah, bankruptcy. Yeah, those things stop the clock.
Right. Right. So next slide. So ultimately, at the end of the day, what this means is that if both collectible assets and remaining income are 0 or less, the taxpayer is CNC eligible. They're also eligible from the standpoint of possibly for an offer and compromise, but again, that's determining on what the number you come up with to see if they can come up with the cash. But many times, this is where, you know, somebody's going to have an offer of $10,000 and they just don't have the $10,000 or be able to come up with it. So that's the person that usually will go into the currently non-collectible. They have 0 income, but they still have some assets that they just can't get, you know, can't divest of, and they can't pay the cash or get the cash to pay it. So they're going to be in the currently non-collectible. So next slide. So this is really the one time when being dead broke and unemployed is a good thing. So, you know, obviously, you're dealing with somebody who hopefully is down in their luck. They were doing well at one point in time, which was what caused the problem in the first place. They just didn't pay the taxes when the going was good, and when things started turning bad, they're robbing Peter to pay Paul, and the biggest person they're robbing is the federal government because they're not paying their taxes. And so when they're doing that, they're down in the this pit of financial zeroness. And when they're down there, that's when you want to file to be in the currently non-collectible status. And that can be in play to their benefit. And hopefully, this will help them, right their ship again and start to live and breathe. Next slide. So again, as I just actually said, if the taxpayer can scrape up together a few together or borrow a few bucks, they might be able to qualify for an offer in compromise. I think, Jason, you've told me that in most cases that you have people that when you calculate the math, $100 is typically your offer, but you've seen many for $1 or heard of others people doing $1 or $10 if the math comes out that way.
Yeah, remember, there is no minimum on the offer in compromise. Whatever the number is what the number is. It just has to be bigger than 0. So
right. It says like 3 or 4 places on the offer form.
Yeah.
It has to be more than 0.
Yeah, that's all they care about. So you can settle a multi-million-dollar liability theoretically for $1, if that's what the math comes out to.
That right.
So.
Right. Okay, next slide. So when you're actively seeking the currently non-collectible status, you're going to submit the full financial package, which means that you're going to submit the 433A for individuals, B for business, or the F if you're dealing with the automated collection, with the full documentation. And as Jason said earlier, with the installment agreements, you're just going to put a simple letter requesting the taxpayer be placed in currently non-collectible status, just to remove all doubt. And here's what we're doing and what we're applying for. So that because again, more often than not, you're probably, at least in the cases that I have dealt with, you're going to be dealing with a revenue officer versus automated collection, but you will also be dealing, you can also deal with currently non-collectible status. Now, please be aware that currently non-collectible status can be granted both by by all this list of people in this group here: service centers, automated collection, the revenue officers, a group manager, appeals officers, or settlement officers. Obviously keep in mind that if you get to appeals and you're dealing with appeals officers or settlement officers, that there is a period where the clock will stop. But be aware that all of these people can approve the currently non-collectible status as long as the documentation approves and mathematically calculates to being in that status. Okay. Now, these are some other codes that can be on a client's account or a taxpayer's account that would basically make them be in a currently non-collectible status. Now, here's an example of one of these that I had. So you say inability to locate the assets or inability to contact the taxpayer. I had a guy who he lived in Georgia. He was married 2000, I think it was 2002 and 3. They owed taxes. They collectively owed about 30 grand. They got divorced in 05. He moved down to Naples, Florida, and then proceeded to not file his taxes. By the time he originally came to me, I think it was 2014. He had been married since 2009 again. She had been filing her own returns, and they eventually found him. They started whacking his wages, and that's what led him to me. But he got put in this currently non-collectible status because they couldn't find him. And eventually, by a W-2 being filed, that's what led them to being able to find him. But it's also common that you're going to have somebody that has no significant estate and they died. They're in bankruptcy or suspension of the business activities with no remaining assets. So basically your company goes out of business. Like my guy that I met with today, they're out of business. There's no assets. It's been closed for almost 10 years now. So you're not going to squeeze blood from a turnip here. And then, of course, there's always special circumstances for our military people. They don't want them dealing or being compromised by having this, but keep in mind that being in this type of status can really jeopardize somebody's status, especially if they have top security type clearances, because they're not supposed to be owing this, and they've really been coming after people, even for contractors that owe money. So this is one of those reasons why they may not be able to want to be in the currently non-collectible status, but unfortunately that may force them in there. So next slide. So which cases get reviews? So ultimately, we've talked about the IMF and BMF, the individual and business master file. That's the overall file that has the computer system that says these are the active collection cases. And when they they put the currently non-collectible status on there, and these are the people that will get looked at. Hardship are the ones we typically are talking about, but unable to locate and unable to contact. Now, those people that fall under number 1 or number 2, those are the people that are more than likely going to get the debt collector calls. Those are the ones that they've been out of the system, and they these people are going to try and track them down and find them. But they've been put in this currently non-collectible status by virtue of they've kind of just disappeared. The people that we're dealing with are the hardship cases, and or they could be in those other categories, but you're trying to put them into the currently non-collectible status, but they're as we said before, they're supposed to be reviewed every year, and when their ability to pay changes, that should raise them to the top of the pile that somebody's going to take a look at that, and then they're going to start getting contacted again to submit new financial information. You have any other questions, comments on the last few slides, Jason?
Nope, just want to remind you on the clock.
Okay, we're almost there, guys. Okay, so lastly, as Jason showed you with the installment agreements, businesses can also be put in the currently non-collectible status. Again, they must meet all these requirements, that they have to be current and compliant. They have no significant equity in assets. Their accounts receivable can't be levied. That's one of those where it has to be in the best interest of you, the client, and the government, because if they start levying accounts receivable, what does that do to their customers? And if their customers start saying, hey, we don't want to have to deal with the IRS, we're leaving you, we're going to pay and go away, and that just puts them out of business, that's not in the best interest of the government. So that's one of those arguments that you'll make if they suggest that. Now, it was suggested by somebody that maybe they have some deadbeats that haven't paid in 6 months or more, that maybe you feed that to the IRS and giving them a bone to go after that. That is possibly something else to consider. But again, you gotta worry about the grapevine of other people talking, and that failure to make tax deposits, again, because that's typically the biggest thing that you're dealing with here is the payroll taxes. But if you don't make your tax deposits or filing returns, then that's going to drop them out of the currently non-collectible status and start causing other problems. The IRS is really putting programs together to try and keep this from happening. So they're starting to get calls from, I've even gotten calls on clients that, hey, they haven't filed a return, or what about this return? And they were like within a couple of months after filing. And then when they get currently non-collectible status, just be aware that the trust fund recovery penalty more than likely will be assessed. So we've got another polling question on the screen. Any other questions?
Keep going, Dan. I just needed to get this up there because people are getting antsy to leave. So I just wanted to get the polling questions up, but keep going.
Then finally here, in conclusion, just like when you're talking about the installment agreement, offer and compromise, you run the numbers and make sure that they actually qualify for it. Let them know you're going to have to run and do the full financial package, just if you were doing an offer and compromise or the various programs for the installment agreement, and you submit this currently non-collectible status to whoever you're really dealing with. If you're dealing with a revenue officer, like I'm dealing with the guy I met today in regards to his payroll tax issue, then if that were the case, submit the currently non-collectible information to the revenue officer. But it could as very well be the service center if it's not even in the collections status. And then, of course, if you have trouble reading or trouble sleeping, the last slide there, we have the super fun time bedtime reading, the Internal Revenue Manual Part 5, Chapter 6, because remember that all of this information that we have is available in the Internal Revenue Manual, so please look at that and go there if you have any other questions. But Jason will be putting up the audio recordings of this so that you guys can go back and review this at your leisure and take your time to absorb it.
Awesome.
And then, of course, the last polling question is on the screen for you that are still there.
Yeah, and the last one is primarily for the CPAs. We managed to stretch this to full 2 hours of CPE, so the CPAs, we can, actually EAs as well.
Right.
George has a good question. Is there an audio version of the IRM? No, there is not, and that would probably be the worst audio book ever.
Yeah, not available on Kindle or Audible or in SoundCloud or anything that I'm aware of.
Not yet, anyway. I got something in the works. I'm bringing back the Inside the IRM series here soon, where I will narrate the entire IRM for your listening pleasure. So that is coming, but it doesn't exist yet. So there you go. Awesome. Any other questions on CNC? I know I was kind of drafting Dan down the highway on that one, so sorry about that.
Frankie asked about there's not a physical edition that I'm aware. It's only available online.
The GPO no longer prints it, so you have to go online to get it.
Yeah, and so it's a very tiny print when you print that, but just go out there and print one section at a time and start reading and review it. When I'm on airplanes, that's my my review time for a lot of that kind of stuff.
The way that they have it laid out on the internet is actually pretty nice. If you go to a page of the IRM and you just hit Control-A, and Control-C, and then paste it into a Word document, the formatting is usually preserved. So what I do is the sections that I need, I just save them as Word documents, especially sections I reference frequently or things like Dan was saying on an airplane if you want to read them. And then I can put those onto my, I email those to myself and keep them in my email. That way I can open them up on the plane and read them if there's no Wi-Fi on the plane or whatever. So, that's what I do. So the formatting is pretty good for pasting over into to Word. Any other questions on CNC?
So hopefully you guys learned some things and have this the audio plus the slides to use as a reference. Jason's got the slide up there that if you guys want to learn about the marketing side, I've got a 5-week marketing training. We've given you the information about coming to Orlando for the level 2, 3, which also includes some marketing, which is the next slide there, Orlando, May 9th through 11th. So George, I expect to see you there. TaxResolutionBootcamp.com. Go out there, register. The price that's on there today will not be the price that's there next month. So there's savings for booking early. Where is that again, Jason, in Orlando?
It's going to be at the Holiday Inn Airport South. So basically, if you land at Orlando International Airport, take the main road going out and head south about a mile, you're there. It's along Hotel Row, basically.
George,
you better be there.
That just popped out. Yeah, George will be there. He's in Orlando. He's apparently on the north side of Orlando. But CNC status. One thing he asked about the passport issue. That if you're dealing with the IRS, they're not going to revoke your passport or deny your passport. It's the people who are going to get their passport revoked or denied are the people who are not dealing with it and they're over the $50,000 threshold.
Right.
So, that's one of those things that, if you have the way to find people who are dealing with, traveling a lot out of the country and their passport is very important to them, that's where you go after those. So.
Yeah, keep in mind that the whole passport thing, passports are controlled by the State Department, not the IRS. So the IRS, for the folks that owe $50,000 or more and are not playing ball, the IRS sends a request basically to the State Department requesting that a passport be revoked or canceled in those situations. So if your taxpayer is playing ball and if they're in an installment agreement or if they're in CNC or if they're in OIC, so they're dealing with the problem, right, then the passport revocation issue is never going to come up. It's only going to be an issue for the folks that are basically, in reality, it's only going to really be an issue for the people that are kind of flipping the bird to the IRS. I mean, that's really what it's going to come down to in all reality.
Yep, and those people exist.
Plenty of them. Yep.
Okay,
George,
guys. Well, thank you for hanging out there.
George, I'm curious, are you up like around Gainesville or is that Ocala or something like that?
No, it sounds like he's in the
Sanford.
The land,
okay.
or
Sanford.
He's near the other airport.
Gotcha. So, folks, tomorrow morning I will be starting the Your Tax Resolution Marketing Plan series. The live sessions of that are free. The recordings will not be. It's kind of a creativelive.com model I'm testing out there. So the live sessions are free. I'll be presenting information that I normally charge people a couple grand for. Okay, so there you go. Those will be Saturday mornings at 10 a.m. Pacific, 1 p.m. Eastern. And for the next 5 weeks, I'll be talking about how to find clients, how to sell the service. I'll get into fees. I can't do that on these CPE presentations again because of antitrust rules and stuff I found out about last year the hard way. So can't talk about that during some of these kind of things, but I will be getting into that during the marketing series. Okay, those are not CPE eligible. So register for those. Just go to taxresolutionmarketing.com. That will forward you to the GoToWebinar registration page for that. So I expect to see a bunch of you there. Certificates of completion for the past 3 weeks, I will send those out tomorrow. That email will also include the links to all of the videos and the slides for the past 3 weeks of this level 1 session. And then for those of you that are serious about participating in tax resolution season, there is a season for 1040 tax resolution work. That season starts in June. Therefore, we give you a couple of week break after tax preparation season. But then if you want to be serious about tax resolution season, come on out to Orlando for 3 days of intensive training on how to get yourself prepared for tax resolution season. I sometimes call it second tax season, where you can actually make far more money than you do during tax prep season. We'll be covering the stuff beyond level 1. And no, George, there's no partying. It will be every day, 8 to 5, pretty intense stuff. And then during the evenings, I guess you can go party. I'm not sure what kind of a party you're going to get into at Disneyland, but it's there, I guess. So go to taxresolutionbootcamp.com. It's in Orlando. For those of you that have never attended a live conference of this type before, it is a different experience than attending your annual CPA or EA Society 2-day meeting. We get into a lot of nitty-gritty about marketing, dealing with clients. We just talk about stuff that is beyond the scope of CPE. There is CPE available at this one for most of the sessions. Some of them are not, just because of the topic of the material. And yes, there is a reduced hotel rate at the Holiday Inn. All that information is available on the Eventbrite page. So if you go to taxresolutionbootcamp.com, that will forward you to the Eventbrite page that contains all of the information. So any closing thoughts, Dan?
No, just enjoyed talking to you guys. Be there on the marketing webinars. Those are good, and hopefully we'll see some of you in Orlando in May.
Awesome. Thank you, everybody, for sticking around for the entire 2 hours. Those of you that did, appreciate that. I'll get the certificates and the recordings out to you tomorrow. And other than that, go forth and maketh thine moolah. Bye-bye, everybody.
Later, Jason.
Take it easy. Da-da-da-da-da-da-da-da-da. This is our closeout music. This is a low-budget production, so it's just Jason singing. Da-da-da-da-da-da-da. Boom!
Oh, that made him run out the door.
We're still alive. That's the scary part.
Yeah, I know, right?